Hi, I'm Suzy Rhoades with PassMasters. Welcome to this video covering Section 2 of the Series 65 exam. I want to start by looking at NASAA's study guide. Published September 1st, 2023, NASA finally put together a study guide for the Series 65 exam. In this video, we will cover investment vehicle characteristics. It is 25% of your exam. There are 32 questions covering the information found within this section. Let's look at the information that is covered within this section of your exam. Types and characteristics of cash and cash equivalents, types of fixed income securities, characteristics and valuation factors of fixed income securities, types of equity securities, characteristics of equity securities, methods used to determine the value of equity securities, equity public offering, types of pooled investments, characteristics of pooled investments, types of derivative securities, that's options, characteristics of derivative securities, alternative investments, insurance-based products, other assets. Within the PassMasters course, you will find there are 16 topics that cover the information you need to know related to Section 2. Each topic is going to have a PDF, then a video where I explain everything covered in that PDF, and a topic quiz. Let's take a topic quiz for Section 2 together. When an investor sells a put, they have paid a premium for the right to buy shares, paid a premium for the right to sell shares, sold an obligation to sell shares, sold an obligation to buy shares. So for every option contract, there are two parties, a buyer and a seller. The buyer always pays a premium. The seller always receives a premium. So we can get rid of A and B because this question is asking about a person who sells a put. So when you sell a put, you have sold an obligation to buy shares. When you buy a put, you have paid a premium for the power to sell your shares at the strike price, which would be more than the current market price. So when you sell a put, you have sold a promise, an obligation that if the current market price is below the strike price, you will buy those shares for how much? The strike price. So you have made a promise. That doesn't mean that it's going to be exercised against you. You, as a person who sold the put, are hoping and praying that the market price does not go below the strike. And if it doesn't, then you end up doing nothing. You collect the premium and do nothing, which when you sell an option is the best case scenario. So when you answer the question, we know we got it right. We got the green check mark. If you have any questions, you can click Show Explanation. When an investor sells, it's me. You can listen to the audio explanation. In a regular way transaction, the latest an investor can place a trade and still receive the dividend is the day prior to the ex-dividend date, payable date, record date, ex-dividend date. Under current Federal Reserve Board Regulation T, in a regular way transaction, you have T+1 business day to pay. That means currently that a stock will go ex-dividend as of the record date. So the latest you can place the trade and still receive the dividend would be the day prior to the ex-dividend date. Which of the following is not true regarding venture capital funds? They tend to have a 10-year exit strategy. The fund manager generally receives an annual management fee as well as a percentage of profits when the business is sold. They tend to invest in young businesses that are not yet fully operational. They invest in stable, well-developed companies. So which one is false about a venture capital fund? The people in a venture capital fund are up for an adventure. They invest in stable, well-developed companies. That is the right answer because it is incorrect. Calls and puts can be exercised any time that the contract is in the money. Who has the power? The buyer. Who has sold an obligation? The seller. This means they are European-style options. The market price must be below the strike price on a call. They are American-style options. The market price must be above the strike price on a put. The fact that they can be exercised any time that the contract is in the money is what we call an American-style option. European-style options like capped index options can only be exercised at expiration, but calls and puts are American style. Those other two choices are backwards. The market price must be above the strike price on a call in order for it to be exercised. The market price must be below the strike price on a put in order for it to be exercised. American style. As soon as it's in the money, the owner can exercise the option. When comparing mutual funds, which of the following is correct? An index fund will have a higher investment management fee than an actively managed fund. When comparing mutual funds with the same historical rate of return, manager tenure should not be considered. Comparing the returns of two actively managed funds over the same time period would be rational. Comparing the past returns of a growth fund to an income fund is reasonable. The only one of those that makes any sense at all, comparing the returns of two actively managed funds over the same time period would be rational. Yes. ABC Company is filed for bankruptcy and is facing liquidation. Which is the correct liquidation order? From who is paid first to paid last. Okay, so let's think about this. Paid first to paid last. Who is paid last in the event of a corporate liquidation? This topic appears twice on the content outline. It's a Section 1 and Section 2 question, actually. Last, common stock. Last, common stock. Where is a choice where common stock is last? Is the only one that has common stock last. Who is paid first? Secured debt is paid first. Secured debt. So a collateral trust certificate is a type of a secured bond backed by collateral securities owned by the company, held in trust. If the company goes broke, then those securities are sold. Collateral trust certificate is a type of secured bond. A debenture is an unsecured corporate bond. It would be paid next. So unsecured creditors would be paid second, then preferred stock, and lastly, common. When a municipal bond is insured, what does that mean? The issuer has sold the bond to an insurer. The issuer has purchased insurance to guarantee the interest payments only. The issuer is an insurance company. The issuer has purchased insurance that guarantees payment of principal and interest. Sometimes municipal bonds are insured, where the issuer has purchased insurance guaranteeing payment of both principal and interest. Safer type of bond, for sure. I mean, don't say safe to your client, but for the test, yes. Which options are bearish? So bearish, up or down? Down. Bears trample you down, right? I mean, hopefully never. Bull up. So we're looking for the options that have down arrows. So if you were to make an options chart, well, let's do it real quick. So the world's fastest options chart. We have calls on the top, puts on the bottom. We have buyers on the left and sellers on the right. When you buy a call, you are bullish. When you sell a call, you are bearish. When you buy a put, you are bearish. When you sell a put, you are bullish. The sellers are also perfectly fine if the stock price moves sideways, meaning that the option stays out of the money. So this question was asking us for the bearish positions. The bearish positions, the buyer of a put, which we also call long, and the seller of a call. These are both bearish. Let's check that question. Short a call and long a put are the two that have down arrows, bearish positions. Which of the following is not true about a REIT? REIT stands for Real Estate Investment Trust. At least 75% of the REIT's assets must be in real estate, cash, and U.S. government securities. They may pay dividends to investors. They trade in the secondary market. They may flow through losses to the shareholders. So a REIT trades in the secondary market like a share of common stock. You can think of it similar to a closed-end mutual fund or an ETF. When you have a stock, do you ever get a bill that says you owe the issuer more money? No, there is never a flow through of losses to the shareholders on a publicly traded security. If you were the owner of a direct participation program, it would flow through losses, or a partner in a limited partnership, the K1 would flow through a loss, but not something that trades in the secondary market like a REIT. No, just positive flow throughs like a dividend. Which of the following is incorrect regarding variable life insurance? It has a minimum guaranteed rate of return. It has a fixed premium. It requires the delivery of a prospectus since it is a securities product. The premiums are put into the insurer's separate account. Which is false. It has a minimum guaranteed rate of return. It has a variable rate of return. The money is invested in the insurance company's separate account. There is a minimum death benefit, but there is no minimum guaranteed rate of return. That is false. It's right because it's wrong. So sometimes that's confusing. Sometimes you want to pick the incorrect answer. Which is not a miscellaneous agricultural commodity? Wool, pork bellies, rubber, lumber. Wool, rubber, and lumber are all miscellaneous agricultural commodities. Pork bellies, they're meat. The dividend discount model is used to adjust for risk, account for inflows of cash into a mutual fund, determine the price at which a stock should be selling at based on the discounted value of future projected dividends, determine which growth stock to buy. The dividend discount model is used to determine the price at which a stock should be selling at based on the discounted value of future projected dividends. Who is it that manages and sells an IPO for the issuer? Municipal advisors, wholesalers, underwriters, investment advisors. It is underwriters, investment bankers, who manage and sell an IPO for the issuer. Treasury bills pay interest semi-annually, quarterly, at maturity, monthly. Treasury bills are sold at a discount. The interest is paid at maturity. They are money market instruments maturing in 4 weeks, 13 weeks, 26 weeks, and 52 weeks. A head and shoulders bottom formation shows a stock that is currently bearish, bullish, inverted, or flat. Pretend I can draw. We've got two types of head and shoulders formations. The top formation kind of looks like a person, shows a stock that is currently bearish going down, and a head and shoulders bottom formation shows a stock price that is bullish currently going up. A convertible bond has a conversion ratio of 20. The current market price of the common stock is 55. What would be the parity price of the bond? Well, this is when I highly suggest that you get out the handy-dandy non-programmable calculator. They will give you one at the test. Please use it, or there's going to be one built into the computer program. Just depends upon where you're taking your test. So for your one convertible bond, you can get how many shares of common? 20. And there are 20 shares. Each one of those shares is worth how much currently? $55. 20 times 55 is $1,100. That is the parity price of the bond. So the bond's going to trade at parity. If it was trading for less than $1,100, then you would want to convert the bond into shares of common stock. That would be below parity. All of the following are true regarding non-fungible tokens, NFTs, except what is false. NFTs are securities. NFTs are digital assets that reside as code on a blockchain, most commonly on the Ethereum blockchain. NFTs can be digital representations of artwork, a video, music, or even a tweet. When an investor buys an NFT, they are buying ownership of that particular bit of alphanumeric code associated with whatever has been tokenized. So the false statement here is NFTs are securities. NFTs are digital assets. The most common type of management company is an open-end fund, an FACC, which stands for Face Amount Certificate Company, UIT, which stands for Unit Investment Trust, or a closed-end fund. So a management company is a type of investment company under the Investment Company Act of 1940. There are two types of management companies, open-end and closed-end funds. The most common type would be the open-end fund. Asset-backed securities are equity, debt, sold by banks, issued by the U.S. government. Asset-backed securities are debt. That's a tricky one. Your client has an account at a bank that requires advance notice before withdrawing funds. What type of account is this? CD, which stands for Certificate of Deposit. NOW, which stands for Negotiable Order of Withdrawal, DDA, which stands for Demand Deposit Account, or Money Market Fund. It is the Negotiable Order of Withdrawal account that requires advance notice before withdrawing funds. Now, it is up to the bank whether or not they enforce this, but you do need to know the concept for the exam. Something like your checking account or your savings account, those are DDAs. Demand deposit accounts, where you can just walk up to the teller and demand all of your money. If an investor buys a stock for $50 and sells a call on that stock for $8, his break-even point on the stock would be, well, let's think about it. They're out $50 to buy the stock, but they're in $8 when they sell the call, leaving them at a net position of $42 a share. So if the price goes below 42 and they have to sell the stock at less than 42, then the investor is losing money. So the break even when you own a stock and have sold a call is 42. So you can use options to hedge the downside risk that you have. The best way to hedge a long stock would be to be long a put, but you can also hedge a long stock with the sale of a call. It only offsets your downside risk by the amount of premium collected. Which of the following types of debt instruments has the least amount of credit risk? Revenue bond, subordinated debenture, mortgage bond, debenture. Are any of those a type of secured bond? Yes, the mortgage bond is the most common type of secured bond. That means that it is backed by land or buildings owned by the corporation that issued the debt, held in trust. In the event of a corporate liquidation, the building or the land is sold off to pay the bond holder. So a mortgage bond has the least amount of credit risk of those. Which of the following statements is true regarding primary versus secondary offerings? Primary distributions are shares sold by existing shareholders, whereas secondary distributions are shares sold by the issuer. Primary offerings are done to raise capital for the issuer. In a secondary offering, the shares are sold by an existing shareholder. In a primary offering, the shares are unlimited. In a secondary offering, the number of shares is set by FINRA rules. The price the shares are sold at in a primary market is the market price. In a secondary distribution, it is a price set by the underwriter. So a primary offering is done to raise capital for the issuer. In a secondary offering, the shares are sold by an existing shareholder. So sometimes an IPO is going to consist of brand new shares and shares sold by existing shareholders. You would need to read the prospectus. Which type of equity security may be converted into shares of common stock? Participating preferred stock, note, debenture. Convertible preferred stock may be converted into shares of common. In an options contract, which of the following is correct? The premium is paid by the seller and is the most they can lose. The seller has the power and the buyer has the obligation. The premium is paid by the buyer and is the most they can make. The buyer has the power and the seller has the obligation. That is the only one of those statements that is correct. The buyer of an option pays a premium to do something. When you buy a call, you pay a premium for the right to buy shares at the strike price. When you sell an option, you have sold an obligation to do something. When you sell a call, you have sold an obligation to sell shares at the strike price. When you buy a put, you have paid a premium for the power to sell your shares at the strike price. When you sell a put, you have sold an obligation, a promise that if the market price is below the strike price, you will buy the shares at the strike price. Owning the shares covers the sale of a call. Having cash covers the sale of a put. Exchange-traded notes are a type of exchange-traded debt security offering a return that is linked to a market index, include equity within their portfolio, are considered liquid and safe, pay periodic interest payments. Exchange-traded notes are a type of exchange-traded debt security offering a return that is linked to a market index. Your client would like to invest $5,000 a month for the next year. The mutual fund he will be investing in has a breakpoint at $50,000. Which statement is the most correct? The client should purchase Class C shares. The client should be told to invest the $60,000 all at once instead. The client could sign a letter of intent and qualify for the breakpoint right away. The client must wait for the account value to break $50,000 to qualify for a breakpoint. $5,000 times 12 is what? $60,000, and a letter of intent is good for up to 13 months. So that is the best answer here. The client could sign a letter of intent and qualify for the breakpoint right away. So what the mutual fund company is going to do is keep some of those shares in an escrow account, charge the reduced sales charge up front, but in case the letter of intent is not fulfilled, they will sell off some of those shares to pay the additional sales charge. So letter of intent good for 13 months. Which of the following securities has the longest period of time until expiration? Options, repurchase agreements, warrants, or REITs. So options are good for, calls and puts are good for 9 months. Repurchase agreements are short term. Warrants are attached to corporate bonds. Corporate bonds are good for up to 30 years. REITs are short term, the ability to maintain proportionate ownership, good for 30 days. So the longest term to expiration is the warrant. Which is false about Viatical and life settlements? They are regulated under state law. There is no active secondary market for these policies. They are regulated under federal law. The longer the insured lives, the better the return for the investor. Viatical and life settlements are regulated under state and federal law. There is no active secondary market for these policies. This is the false statement. The longer the insured lives, the better the return for the investor. No, the sooner the insured dies, the better the return for the investor, which is why I've always found these to be a little bit creepy, if you will. You should never hope someone dies. It seems like something that's wrong as far as investing goes. Which client would be most suitable for a variable annuity? Morgan just refinanced his home and is considering buying a variable annuity. Mitch is considering cashing out his whole life policy to buy a variable annuity. Helen is considering taking out a home equity loan to fund a variable annuity. Jennifer has $100,000 in cash and is considering buying a variable annuity. You never want your client to take money out of their home to buy an investment. So when your client has cash, they would be the best client to recommend the purchase of a variable annuity. All of the following would be used by quantitative analysts except, so quantitative technical charts and graphs. We're looking for what is not used by a technical analyst. Price, volume, current assets, short interest. There's two types of analysts, quantitative and qualitative. Qualitative use the financials, also called fundamental analysts. Current assets are found on the balance sheet, so which would not be used by quantitative analysts. Current assets is the answer. Digital assets represent a safe investment, are most likely a fad that won't be around long, are risky and suitable for aggressive investors who can afford to lose money, belong in all investors' portfolios. The best choice here, digital assets are risky and suitable for aggressive investors who can afford to lose money. All right, great job. Section 2 has an incredible depth of knowledge that is required to do well. This section will be especially challenging for those of you who do not have a product license. So it is perfectly legal to get your investment advisor representative license, your Series 65, without taking the SIE exam, without having a Series 6 or 7 license. It makes it a harder exam. So those of you who do have your SIE and 6 or 7 top-off exam, if you've already done that, there is a lot of review for Section 2. So you definitely need to know a lot. You need to review what you already learned for those other exams. But if you're taking 65 and don't hold a product license, this can be a challenging section for you. Remember, the PassMasters online course includes in-depth explanations related to all of these topics. If you are interested in checking it out, there is a link in this video. Thank you so much for watching. I hope you learned something. Keep up the good work. Be sure to give this video a thumbs up, subscribe to our channel, and turn those notifications on so you know when our next video is released. Happy studies. You got this. Study, 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 pass.